Do you want to make $1,000 per year in dividend income? Today, I'm going to go over 5 popular stocks that all pay more than 6% and show you how much you'd have to invest in each one of them to collect that kind of yield. And most importantly, if they're good and safe income stocks to hold. So I'm going to start from highest to lowest. And at the top of my list, I've got Medical Properties Trust. This is a really popular real estate investment trust. Right now, yields 12.4%. That's an incredibly high dividend yield. So if you invested about $7,900 in the stock right now, that's all it would take to get $1,000 per year in dividends. Right now, the company pays 15 cents per payment every quarter. So it's a fairly high yield given the stock's only trading at $4.7. But the problem with Medical Properties Trust is the stock is facing a lot of uncertainty. One of its key tenants, Steward Health, recently filed for bankruptcy protection. So there's a big risk, big unknown as to what Medical Properties portfolio is going to look like. How well is Steward Health going to be able to sell its hospitals? What's going to happen to Medical Properties portfolio? Is it going to be able to continue paying a dividend? Last year, it actually cut its dividend almost in half, from 29 cents down to 15 cents. So it's already slashed its dividend once. But the problem is that doesn't guarantee that it's going to slash it again. And the other problem is that this has been an awful investment over the years. So in the past 5 years, it's down 74%. So sure, you could hang on to the stock for a year, collect a $1,000 dividend, assuming, of course, that it stays intact. But during that time, you might lose 30%, 40% of your investment potential, because right now, there's no guarantee that it hasn't bottomed out yet. Right now, it's market cap $2.8 billion, but Medical Property Trust has been selling off assets for the sake of raising money. That's not really sustainable, and it's also a really troubling sign for income investors, because that means that the company's not generating enough money, and sooner or later there might be another dividend cut, or maybe it just wipes out the dividend entirely, depending on the state of its financials. So this is a highly risky stock. I don't think it's worth the risk, but it's a really popular one, so I just want to cover it. And it's 12.4% yield. It's attractive, but it comes with a ton of risk. Next, I've got BCE, Bell Canada. So they pay 8.7%, or another really high yield. So this stock, you'll have to pay a little bit more to get $1,000 in dividends. You're talking about $11,500 at this kind of yield. That's still not too bad. It's still a very high yielding stock. What I like about BCE is it's a lot safer than Medical Properties Trust, despite its yield. It's a telecom company in Canada, so it's an industry leader. It's pretty safe as far as income stocks go. There's not a whole lot of competition in telecom in Canada, so for better or worse, BCE is going to be a big name there, regardless of what happens. The main reason why the stock's been nosediving, I think, is just to do with interest rates. Telecom stocks in general have been falling since interest rates have been going up, because investors have other options to make a good return elsewhere. So dividend stocks aren't as highly coveted as they normally would be. But I think BCE is a really good option for income investors. So this is one of the safer ones I would consider buying. Next, we've got Altria. So the tobacco company, 8.4% dividend yield. So it's pretty similar to BCE. So to get $1,000 in dividend income from this stock, you'll need to spend about $11,900 investing in Altria. Now, the downside with Altria is this is a little bit of a risky stock, just because sales are declining. The tobacco company obviously is still relying heavily on tobacco and cigarette sales, and the future outlook for that industry isn't good. The number of smokers is declining, so it's a bit of a risky play. It's not one that I would buy just because of that uncertainty. It's been trying to transition to harm reduction products, but that being said, the vast majority of its business still relies on cigarettes, and so it's for that reason it's a bit risky. If we look at its payout ratio, right now we've got about 81%, But as its earnings get worse, that percentage could climb higher. And so there may not be a lot of room for the company to continue paying a dividend. It's been a safe dividend stock for years, but it's not one that I would suggest hanging on to just because of that long-term risk. Because when you buy a dividend stock, generally you want to be able to hang on to it for a long time, not worry about it. Next, I've got Enbridge. So 7.6% dividend yield. Enbridge, you're looking at an investment of about $13,200 roughly, so a little bit higher than the others. But Enbridge is also one of the safer stocks I'd suggest for dividend investors, just because although it's an oil and gas, this is a pipeline company, so its business is fairly stable. It relies on long-term contracts. It has a really good track record for stability and meeting earnings expectations, and it's grown its dividend for decades. So it's a really safe stock to own, and over time you can see your dividend income rise as well. So a fairly safe one in Enbridge. Last on this list is Walgreens Boots Alliance. So right now its dividend yield is the lowest at 6.3%, but the way the stock is going, it could dip. That yield could get higher as that stock comes down. And so to collect $1,000, you need to invest about $15,900 into the stock to generate that amount of income. Now, like with Medical Properties Trust, though, Walgreens recently cut its dividend. So earlier this year, it had its new CEO, Tim Wentworth, slashed it from 48 cents down to 25 cents per quarter. And so even with that reduction, though, it's still a fairly high yield that you're getting with the stock. But again, Walgreens is another really bad investment over the years, down 70% over 5 years. And right now, there's not a lot of optimism that things are going to get a lot better anytime soon. The company's been investing into healthcare, so it's been spending a lot of money on growth initiatives. And so sooner or later, there might be even more bad news with the dividend. I think at some point it's going to potentially reduce it, or maybe just eliminate it entirely. When it cut its dividend, it broke a streak of increasing its dividend for decades. It was closing in on 50 years of consecutive increases. So that was a pretty seismic move for the company to stop that streak and to slash its dividend. So I think the next step might be just to wipe it out entirely, especially if it's going in deeper into healthcare and trying to transform its operations. So Walgreens is a highly risky stock in that sense, because for dividend investors, they've already been burned once with a dividend cut. The stock's losing value, and this is just a stock that's probably safer to avoid. So of the 5 stocks that I talked about, Medical Properties, BC, Altria, Enbridge, and Walgreens, the 2 ones that I would suggest for dividend investors is BCE, telecom company, 8.7%, and Enbridge, pipeline company, 7.6%. These are going to be the best dividend stocks on this list to buy and hold.